and welcome to this month's Capital Markets View. I'm very pleased to say, certainly in London and I think the rest of Europe, the sun is out. We have summer. How are you, Taron?
I'm good. I'm really enjoying this warm weather. Reminds me of home, so that's nice.
Yeah, and it's rosé time. I mean, not at this moment when we're recording, but
After we record.
Yeah. Hey, the sun's going down somewhere in the world, so it's a sundowner, so not a problem. Right, so let's dive straight into our first slide with data on the European new issuance slide. And despite the fact that Q2 is down on what was clearly a gangbusters Q1, I think we can still say if you compare what's happened last quarter and this year, compared with what I call the before times, so like a normal year, 2019, we're still doing pretty good. Volumes are still pretty good, even in Q2.
Yeah, and the reason I wanted to show the slide like this is I think you can see that how much of a spike in Q1 there was in terms of opportunistic issuance when pricing was really favorable for issuers. But then you can see the blue bars, which show actually how strong M&A financing has been in the second quarter so far. So this is only till the end of May. So this is a bit of a curtain raiser on second quarter volumes. But so I just think it's really interesting how strong this sort of so-called new money issuance has actually been in the second quarter and in the first quarter. But
that rhymes with what my colleagues across the whole of Europe are saying. They have a pretty good pipeline, and they're quite happy with issuance projections going forward, which again, and I'll say it again, goes against what I was saying at the end of last year, beginning of this year. I was a bit worried about Q3. There will be a natural summer lull, but other than that, I think it's going to be cool.
Yeah.
Right, slide with distressed LE loans May 2020. So just as the pandemic was sadly really beginning to hit. And I think you have something to say about the kind of range you have here.
Yeah, so we've talked on this. We've talked a lot about the V-shaped recovery for secondary pricing, you and I, and the fact that the weighted average bids have climbed back above the pre-pandemic sell-off, sell-off high. And when I wrote the LE monthly article last month for the end of May, you could see that returns in the LE, it was actually the 14th consecutive month where we have positive returns. So we've been talking lots and lots about sort of secondary and how strong it is, but I just thought it would be interesting to kind of look at how the other side of things, the number of distressed loans in the index and kind of where they were and where we are now. So you can see how many different sectors there were. These are loans that are trading at below 80 in the index. So when you look actually at where we are this year in the same...
I'll go to the next slide. I mean, in this slide, it's kind of, leisure, retail, hotels, which I guess is not a surprise. And then we'll go to the next slide, which is distressed loans for May this year.
Yeah, so there are only five industries that have loans in this category. Obviously, retailers is still there. Home furnishings, I don't know, that's a little bit of a surprise because I think people are doing a lot for home, around their home, but potentially this is, these are bigger purchases and that could be why. But it's just fewer sectors. So this is just another thing that's pointing to the secondary recovery for the leverage loan universe.
So I guess if you think about it, what people must have been thinking last year was, oh my goodness, quite a lot of companies are going to be affected, and then jump 12 months, and the market has really decided which are the sectors that it really feels are going to be impacted by the pandemic.
Yeah, and just another thing to point out is that when you looked at the data from the sort of gainers in May, actually hotel beds, Park Reunidos, those were some of the credits that traded up. So credits in the sort of leisure, hotels, we saw some gaming companies. So there's a lot of searching for credits that are trading at a discount in the secondary market. So a lot of these sort of hit sectors are trading up.
Yeah. Well, goodness gracious. Don't know about you, but you try booking a cottage in the UK next year. My goodness, demand is going through the roof. So yeah, some sectors are going to really rebound. Cool. Okay, let's go on to our next slide, which is CLO issuance. So Q2 down on Q1, but still, the total figure is really good compared with the before times. I think it's down because some key AAA investors in America have taken a pause. I've heard that A, they're full, B, the swap rates don't work for them. And then, of course, we know there's one large Japanese investor which is no longer investing either in new or in refinancing deals. So you've got some big investors out, and then a very unusual issuance year. So you have normal CLOs, CLOs, so as in new CLOs this year, CLOs that would naturally refinance this year, CLOs that should have naturally refinanced last year but didn't, and CLOs that occurred last year but did at high prices and you can now refinance them. So you've got four things coming to the market. So a real oversupply compared with the demand, certainly at the AAA level.
Yeah, and it seems like the market's in price discovery mode with spreads on AAAs that have widened to the mid to high 80s.
Yeah.
And
Well, let's go to our next slide, which is weighted average cost of capital for a CLO for TL and versus loan TLBs, and actually some AAAs heading towards or around 1%. So we're up from the 80 basis points.
yeah, and Michael just wrote a topical on the CLO market, and in it he talked about how market sources have said that the mezzanine bid has stayed strong, but on last two new issue deals there was a little bit of widening on those recent prints, although people are saying it's still quite well supported, and the arbitrage is still there. It's about 216 basis points between the weighted average cost of capital and term loan B spreads. So
it's above the magic 2%, which we all think is where they are, is the tipping point as to whether people think it works or it doesn't work.
Yeah, and I mean, you can see in the chart as well that primary deals are getting done a little bit wider. Yields have gone up at the end of the second quarter. Why is that? Well, they did get very low in the first quarter, but there is a bit of credit differentiation. So, Euribor plus 375 basis points for a good single B flat name, with the 350 is kind of reserved for the most popular credits. So yeah, and we're still seeing reverse flexes outnumber the upward moves, but it's more palatable to the investors because they're actually tightening the OIDs instead of reducing the margins, and investors like that better because it impacts the yield less over the longer term. But I guess I think the investors CLOs are still looking for discounted names to try to increase that spread and increase that arbitrage, because they say they need an average margin of about 385.
Okay. So fundamentally, this graph shows a slight uptick in CLO liability costs, a slight uptick in loan pricing, for very different reasons. Loan pricing, I think, as you just alluded to, may be ticking up a bit because the credit quality of what's being issued is not the best, to be polite. So that means slightly higher yields. And then on the CLO side, we've talked about how there's a oversupply and an under demand. So for very different reasons, both markets are resulting in slight upticks in pricing.
Yeah. But there are lots of warehouses building, over 50 we hear, and I guess the ramping deals is quite comfortable because there is so much new issuance. But it's this issue around liability spreads and sort of timing the pricing of the deals.
Yeah, yeah, no, I mean, you're. I mean, I think you and I would agree that the 50 warehouse number is perhaps on the conservative side. There might be, approaching 60, and certainly we estimate that there are over 100 existing CLOs that need to be that could be refinanced this year if the pricing works. So yeah, there's still quite a lot of activity in CLO world that needs to happen. Cool, excellent. Right, thank you very much.
No problem.
Like I said, not quite yet, but rosé. The rosé's in the fridge. Let's put it that way.
Yes. And next month we'll talk about quarter end. Maybe we'll touch on the US a little bit and sort of look
Yeah,
at where we are so far in this year.
and you know what? Particularly in CLO world, it'll be interesting to compare how things are happening, bearing in mind what I said about FX not necessarily working at the moment. So are the American investors really ramping up their American CLO investment rather than global? So let's have a look at that too. Right, thank you very much. Thank you for listening if you've managed to get this far. And if any of you have any questions, feel free to contact me or Taron. Thank you.